The following production is presented by League InfoSite and the Credit Union Broadcast Experience, QTV.
Hello, I'm Sean Wolbert, and this is Gloria Ledoux, bringing you the quarterly compliance update at the CU Compliance Connection by InfoSite on Cube TV.
As Sean mentioned, my name is Gloria Ledoux, and I'm the new addition to the Michigan Credit Union League, and very happy to be here with you all today. I've been working in compliance for over 10 years now. I started my career on the banking side, but for the past couple of years, I've been working with credit unions, which has been wonderful. So thank you for having me.
This presentation will provide information on the compliance issues your credit union has worked on in the first quarter of 2013 and the issues it will face in the second quarter of 2013. The first quarter of this year, for 2013, we're going to look at the IRS non-resident alien rules, the NCUA thresholds, the U.S. Treasury electronic benefit payments, HMDA data submission, the NCUA TIPS investments, and the International Remittance Transfer Delayed Rule.
We will also go over compliance items that have an implementation deadline in the second quarter. So a few things you will need to have on your radar. The first is the BSA new forms and electronic filing. Second, the CFPB escrow requirements for higher price mortgage loans. Also, the prohibition on mandatory arbitration agreements. And the financing of credit insurance on mortgage loans. Lastly, the NCUA investment evaluation.
The first issue that we're going to discuss today is interest earned by non-resident aliens. Now, this is a new requirement that needs to be reported from January 1st through December 31st of 2013, but you will report it by March 15th of 2014. This only applies to interest earned, which is $10 or greater, and is currently required for Canadian non-resident aliens.
This has been a requirement for Canadian non-resident aliens, so credit unions should be familiar with the process.
The second issue we're going to address today is actually a regulatory benefit that the NCUA passed for small credit unions. This year, it increased the asset threshold for small credit unions to $50 million. Now, this is beneficial because it's going to change the troubled condition definition. So if your credit union's net income ratio isn't quite right and it falls below that regulatory level that it must meet, it doesn't mean you're automatically in troubled condition. Another great thing about this is that if you have interest rate risk requirement on the rules, if you're under 50 million, you don't have to have a policy in place. It's still a good idea to have a policy in place because you need to understand how your credit union is going to address interest rate risk that the credit union faces based on the rate environment that we're currently in, the fact that eventually the Federal Reserve will release interest rates and they'll begin to rise, which will have an effect on credit unions with the low rates that they're offering on loan products today. So that low income designation acceptance period has gone from 30 days to 90 days. And the important thing about that change is that the 30 days wasn't long enough for a board of directors to actually make a decision.
Yep, so credit unions do now have that 90 days to accept the designation as opposed to the previous 30. And as a reminder, some of the benefits for having a low-income designation are the member business lending cap exemption, which is a good exemption, the non-member deposit acceptance, the authorization to accept secondary capital, and eligible for community development revolving loan fund.
Now this becomes effective February 19th of 2013.
As of March 1st, 2013, the Treasury will no longer issue paper checks. Benefits will be received electronically. So this is a good opportunity for credit unions to help educate their members and make sure their account is set up properly for direct deposit.
Now, one of the other important things about this is that they're going to start issuing these Direct Express cards to members if they're not signed up for electronic deposit. And when they get these cards in the mail, they may not understand that this is their Social Security benefit. So talking with your members and being interactive with them about this process will help them to understand how to get set up on electronic benefits. They also, the Social Security Administration will allow you to help members set up those benefit accounts for electronic deposit from the credit union. So they have an interactive site that a credit union employee can actually help a member from their desk, which is beneficial for the members as well.
Absolutely.
Now, I want to tell you a little bit about HMDA today. I know a lot of people don't like HMDA, and there are many credit unions that aren't even required to report for HMDA because you're not over $41 million in assets. But for those of you who are, this is going to be very important. Now, as of March 1st, 2013, you had to have your HMDA data turned in. And the thing I want to state is that for the first time since 2010, we have a new Getting It Right brochure. That's something that when the FDIC knew that the CFPB was going to be taking over the rule, they didn't publish a guide. HUD didn't publish a guide. There wasn't any guidance that happened. So now we have our new guide, the HMDA Reporting Getting It Right, and that is available on the HUD website.
In January, the NCUA also hosted a HMDA webinar that addressed accuracy and timeliness issues. And then again on April 4th, they hosted a Fair Lending Compliance Program webinar. During the April 4th webinar, they discussed the importance of accurate HMDA information, since that data is evaluated for determining fair lending exams. So credit unions want to make sure that they're providing accurate data in HMDA.
Yep.
As of the end of March, federal credit unions are permitted to invest in Treasury Inflation Protected Securities, or TIPS. TIPS are issued by the Department of Treasury and are guaranteed by the U.S. government. Interest payments will increase with inflation and decrease with deflation. Credit unions can use TIPS as a portfolio risk management tool as the economy enters a rising risk rate environment.
And we are entering that environment. Like I said before earlier in the slides, when the Federal Reserve starts to allow interest rates to rise, there is a chance that we will go into an inflationary period, and credit unions need to prepare for that and make investments that will steady out their income earnings.
Right.
And now we're going to talk about one of my absolute favorite topics. And I joke about that because it's probably the thing that I am most against as far as our regulatory environment currently, and that's international remittance transfers. Now, with the international remittance transfers, it's important to understand that this is a perfect example of how the CFPB is actually implementing regulations with us. The whole thing started in 2011 when the new rules and amendments were given to the CFPB. So as of July 21st, 2011, the CFPB took over international remittance transfers. It gave us new rules, and at the exact same day provided an amendment. So knowing that the rules weren't structured enough for credit unions and financial institutions as a whole in our industry to implement, they introduced an amendment at the same time. In August of 2012, they provided the 100 international remittance transfer exemptions, which means that if you do less than 100 international remittance transfers in a year, you don't have to comply with the new rule. And then in November of 2012, they issued further amendments to the rule. So we've gone through 3 amendment processes to one rule within a year. And then in January, they delayed it and offered an additional amendment in 2013. When's the effective date? We really don't know yet. Now that we've covered the compliance issues that credit unions have worked to implement over the first quarter of 2013, we need to address upcoming compliance challenges credit unions will have to manage in the second quarter of 2013. One of the issues that we need to talk about for the second quarter of this year is BSA e-filing. Now, this is extremely important for credit unions. As of last year, it was required for electronic filing, but several credit unions were able to get an exemption because of the technology issues they faced in implementing electronic capabilities. We also have a new CTR and SAR format, so if you're using the old forms to input information into your computer, the data fields don't line up. This is particularly difficult for smaller institutions, we've noticed, and I can't stress how important this is. The e-filing is required, and FinCEN has even stated to the financial services industry that if they don't implement the electronic filing and they send in paper forms, they will provide a civil money penalty for not following BSA, which could lead to other regulatory requirements and exam issues in the future.
Since 2010, credit unions have been required to escrow for higher priced mortgage loans secured by first lien on a principal dwelling for 1 year. As of June 1st, 2013, that requirement has increased to 5 years. However, the CFPB has provided for an exemption for small creditors if all of the conditions are met. lending activity in rural or underserved counties, assets of less than $2 billion, and they originate with their affiliates less than 500 first lien mortgages. You and your affiliates cannot maintain escrows.
Now, it's important to note with this is kind of a strange twist of fate that the CFPB did. They published a guide to help us understand the escrow rules, and within the guide, they gave us further guidance on how to do this. As a part of that guidance, they stated that after June 1st, if you are escrowing currently but want to take advantage of that exemption, you can't escrow anymore. So it's important to understand that as you move forward.
And there are exemptions for escrows maintained under the previous HOEPA rules. And escrows also established after the consummation for distressed consumers. In addition to the final rule published on January 10th and the proposed rule with request for public comment published on April 12th, and the CFPB also published the Small Entity Compliance Guide on April 18th, all of which provide detail on how to make the rural and underserved determinations.
And isn't this so much like the International
Yes.
Remittance Transfer Rule? It's You publish it, you give us amendments, you give us a guide, you change the rules, you publish more amendments. It's confusing for credit unions as a whole.
And they have a lot to read.
One of the other things that it's important to know in the new mortgage loan originator compensation rules is a requirement that the credit union not have binding arbitration agreements in their loan documents. Now, this is something that many credit unions do have, and if you and I, as a credit union, and you as a member, enter into a mortgage agreement, most loan documents have this clause called a binding arbitration agreement that says that if we disagree, we have to go to arbitration, and you as the member can't take me to court. So as of June 1st, 2013, those binding arbitration agreements are not allowed to be in mortgage agreements or mortgage documents. Another aspect of the mortgage loan originator compensation rules is a prohibition against credit insurance. It prohibits the financing of any premiums or fees for credit insurance, such as credit life and disability insurance, in connection with the consumer credit transaction that's secured by a dwelling, but allows the credit insurance to be paid for on a monthly basis.
We've also heard that the CFPB has heard from other agencies on this rule, including CUNA, and further clarification is necessary surrounding certain key terms in the final rule. So we may see another proposed amendment, I know you're surprised, coming out soon.
In evaluating the creditworthiness of a security, a credit union may consider any of the following factors to be appropriate: credit spreads, security-related research, internal or external credit risk assessments, default statistics, inclusion on index, credit enhancements, price and yield consistencies, and asset class specific factors. Now this goes into effect on June 11th of 2013.
This concludes our overview of compliance issues your credit union has faced and it is facing in the first half of 2013.
Thank you for joining Gloria and I at the CU Compliance Connection, and stay tuned for a further broadcast on issues that affect your credit union. We're here to help you at the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.